Okay, good morning and happy Friday, everyone. Today is April 24th. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and we're here to take a look at the market outlook as usual. Now, we have a lot to cover here today, so let's go ahead and get started. Before we do, just a quick disclaimer, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's start off by talking about where we currently stand as far as the market goes. As we've been talking about for the last few weeks, after the initial sell-off, the markets have retraced about a little over 50% since that 218 bottom on SPY, and really has been consolidating for quite some time, for a number of weeks now, or a couple of weeks now, in between this 284, 272 level, which is a little bit easier to see on the hourly chart here. But we've been very much range bound for quite some time. Every time the markets moves higher, it gets rejected. Every time it moves lower, it starts to bounce higher off that 272 low. Markets are looking a little stronger this morning after looking relatively weak into yesterday's close. So right now we're about to open up just a 0.5% higher after Eli Lilly reported decent earnings, and American Express disappointed a little bit on earnings earlier today. So that's where the current market sits. You know, as far as the fact that the market has been trading in this tighter range leads us to believe that you're going to get a breakout one way or another. The question is, which way is the market going to break out? We're going to look at some of the data here today that we've been looking at that may suggest that, you know, at least right now, the market isn't very pessimistic that it might look like it's going to break out to the upside. But let's take a look at some of the research that we're currently watching. The one thing I will point out here that we've been talking about for quite a few weeks is that as markets continue to slightly grind higher, momentum continues to move lower, telling us that there's definitely exhaustion here in this particular rally. You know, usually this type of exhaustion needs to work itself out before it can continue to move higher. So we're going to continue monitoring the markets, but again, 272 is the low that we're watching on SPY. 284 is the major resistance level that multiple times the market has kind of topped out on, almost looking like a bit of like a head and shoulders pattern here. But again, let's take a look at some of the research as far as the underlying fundamentals. So we just said markets right now are very range bound between that 272, 284 level. We're really looking for a breakout in one direction or another. If we look at some of the other things, you know, VIX is back in contango. So the front month VIX is now trading below the 3-month VIX, which is, generally speaking, we consider that as a risk on metric. When the front month VIX is higher than the 3-month VIX, that's when we consider that as a bit of a risk off scenario. So as you can see here right now, the VIX is currently trading in this VIX is currently at 38, 3-month VIX is 40, so the front month VIX is below the 3-month VIX. Now, liquidity continues to improve. So for those of you that follow our liquidity tracker, right now, as of yesterday's close, we have about 167 very liquid symbols. This is the most we've seen in a long time. You know, during the sell-off, this number was in the 20s. So the fact that we're back into the hundreds, almost 200 names in the very liquid names is a great thing for options traders, meaning that you have a lot more opportunities to take directional views on single stocks, not just on the individual ETFs, but being able to take advantage of options liquidity in this current market environment. And for those of you, Ludmilla, I will get to that in 1 second as far as how you can access those reports, because they are now all available to you directly on your OptionsPlay platform. So liquidity continues to improve. This means that we have more opportunities in the market. Now, oil stabilizing, I also think, is a very big factor in the fact that we may be looking for another push to the upside on equity markets, because the oil markets is really driven a lot of the sell-off in this particular market, or a lot of the weakness in this particular sector, because, as I said, for those of you that joined me here on Tuesday, the oil markets, in my opinion, actually represent a lot of the disconnect that we currently see in the equity markets with the rest of the world, because the oil markets show us how little demand there really is. You know, in a well-functioning economy where everything is back to normal, there's going to be substantially higher demand, especially with oil this cheap. Yet with oil at these prices, there's almost no demand. That's what drove oil futures to be negative earlier this week. A lot of that is caused by USO, the ETF that holds a very large amount of open interest of that front month contract, and they were trying to get out of that contract to avoid physical delivery, and simply no one wanted to take it off their hands. And that just speaks to how little demand there is for oil. And again, I think that is the disconnect that I currently see with respect to the equity markets and where we currently sit as a global economy. Now, one of the things that I do, so we have VIX back in contango, liquidity is improving, oil is stabilizing. These are all net positives, in my opinion, for the overall market. Spending also, we've seen, has gotten a boost. So we're going to take a look at some of the high frequency credit card data we've been looking at for the last few weeks. We want to show you how we've seen some significant boost in consumer spending. A lot of it is due to stimulus and tax refunds, because if you look at the timing of it. However, so what that leads me to believe that type of consumer spending or increase in consumer spending is likely going to be somewhat short-lived for maybe in the next few weeks, maybe a month or two. But that is likely going to start tapering down a little. But the question is really how far, when does consumer spending get back to normal? So we have some of the data also to take a look at, because consumer sentiment data and travel data seems to be finding a bottom. So I want to show you some of the consumer sentiment data, some of the travel data that we're currently looking at, and then earnings season has been a bit of a mixed bag here. So a lot to cover here today. Let's start taking a look at some of the charts. So first of all, this is the credit card data compiled by Bank of America that we've been watching for the last few weeks now. Travel and travel, entertainment, lodging, clearly still in this space where it's really seeing almost no increase in terms of spending, and that's to be expected for quite some time. Restaurants, starting to see a little bit of improvement here on the restaurants side. Most of it, I presume, is going to be online spending, and that's some of the things we're going to take a look at. That restaurants that have been able to shift to more of an online strategy or digital strategy, we're seeing slightly improvements there. The big jump here really comes from online electronics, and notice how the bifurcation here is around April 15th. So this is tax refunds and this is stimulus spending that came in right on the 15th and going forward. And we're seeing that across multiple categories: total online sales, online electronics, groceries also picking up a little. So people taking their stimulus money and buying things that they need, or perhaps things that they didn't purchase prior to that. So, and we obviously see a bit of a dip here for Easter, which was this particular day, that was particular week. But then after the 15th, things really started to pick up across many categories, including home improvement. Home improvement is up 20-30%. And if you look at total card spend, this was predominantly been in the -20, -30% range for weeks now. And as you can see over the last few days, this has really started to pick up, almost getting back close to zero. So again, this is due to stimulus and tax refund spending, which again is relatively short term and is going to taper off. But we are starting to see signs of potentially a bottom in terms of consumer spending. And remember, our US economy is driven 70% by consumer spending, which is why it's so important for us to track this type of data. Now, what's interesting, again, and I think we saw a little bit of that from the previous chart, is really just the bifurcation that we're currently seeing between companies that have been able to shift their sales online versus companies that have not. So in the blue line here, this is again Bank of America credit card data. The blue line is total card spend. As you can see, that is still in a decline. It's starting to get back close to normal, but again, that's due to the stimulus and tax refund spend. But as you can see, total online retail has actually grown almost 80%. So we're continuing to see this bifurcation in spending between online versus total card spend, which means that if you're thinking about investing in any type of consumer related stocks, you should focus on understanding which companies have a strong digital strategy, which companies have a strong online presence, and they're able to shift their sales online. Those are the companies that you want to focus your attention on. And just an example of that is Dollar General versus Dollar Tree. Very similar company in terms of discount retailer, but one company, Dollar General, has invested heavily over the last few years in becoming more of a digital strategy, following the footsteps, I would say, of Walmart, but on obviously a much smaller scale, versus Dollar Tree, selling many of the same products, but not diversifying into as many products as Dollar General, and certainly not diversifying into an online strategy, offering self-checkouts, offering online ordering and picking up in stores. So we're seeing a clear bifurcation in stores like that. And that is how you should think about investing going forward, as this world is continuing to shift to more of an online world. And we're seeing that very much in the current numbers right now. The other category is restaurants. Restaurants have been down pretty much consistently 50% since the coronavirus. As you can see, we've basically hovered pretty consistently around that 50%. Looks like we're starting to get a bit of a small bump. Again, hard to say if this is due to stimulus spending or this is going to last for a while, but what is clear is the trend of online spending for restaurants. So think about companies like Domino's Pizza, Papa John's, and even Chipotle. These are companies that have invested heavily in a digital strategy and have been providing their restaurant. They've been providing their food services online, and they've seen a significantly increase in spending because you can't go to your local restaurant and go sit there. So where are you going to spend your money when you want to eat out? You're going to eat at Domino's Pizza and Chipotle. So those are the companies that have really taken off. You know, for those of you that follow stocks like Domino's Pizza and Chipotle, you'll see that they're near all-time highs, if not at all-time highs. And then you have stocks like Shake Shack that do not have a digital strategy, that do not provide a lot of their foods online, you know, except through a few local delivery services. These are stocks that are going to continue to underperform and likely have to cut costs. You know, Shake Shack had to return some of their money that they took from the PPP loans. So there's a lot of concerns for companies or restaurants that have not been able to shift their strategies online. So as you think about opportunities going forward, think about this digital strategy and whether the companies that you're investing in have this digital strategy, especially in the consumer space. What I want to take a look at is some of the consumer sentiment data, because this is something that we've been tracking for quite some time. We've been talking about how consumer sentiment data has really just fallen off a cliff. But I will say over the last couple of days, things have started to bottom out. Now, the conditions are still decreasing. So I want to be very clear that the conditions themselves still continue to bottom, or still continue to worsen, but consumer expectations have started to bottom out. Now, is this temporary and is it going to continue moving lower? It's hard to say. It's only been just a couple of days, but at least what we're seeing is somewhat of a bottoming out process. So a lot of questions over the last few weeks about, is it time to buy certain stocks? Is it time to get back into you know, some stocks that have really taken some big hits? You know, this is a type of data that we were looking for to suggest when it might be time to get in. Those are some of the opportunities we're going to look at here today. So travel data is definitely one that we want to focus on, because a lot of questions around when is it time to get back into airlines and hotels and some of the other categories that have really taken the biggest hits that may have the opportunities to bounce the highest. So we wanted to take a look at travel data. So first, let's take a look at the US airports TSA data, right? So I'd say a week ago, or no, 2 weeks ago, we were saying that TSA travel was down about 95% from normal. As of this week, that number is still pretty much at 95, 96%. So we would say that this is pretty much bottoming out. Now, part of the bottoming out is because you can't really go any lower than where we currently are, but at least what we're starting to see is just more consistency in terms of a bottoming out process. This is San Francisco subway ridership. This is New York ridership, really nearing a bottom, and probably, you know, in the next few weeks, potentially going to slowly rise. I don't think this rise is going to happen in any quick fashion. I really think that this is going to be a very slow kind of process, if you will. But this is the type of data that we're currently looking at, and looking to see if there's any increase in ridership. As that increases, that's really, in my opinion, telling me the confidence that people have to get back out there, to get to work, to start going to restaurants and spending money. Until that type of data starts to lift up, I'm a little concerned about getting into some of these names just yet. But again, the data is starting to look quite it looks like it's bottoming out. So some of the names that I wanted to start taking a look at, because we've been poring over some of the research reports as well as some of the earnings reports. So last week, Delta reported earnings. If you look at those earnings announcements, what's interesting about Delta is that they've really focused on liquidity, which is, in my opinion, the most important thing for these airlines at this point. A lot of airlines have either gone into administration or have required a bailout to stay operating. Delta is going to get a few $1 billion from the government, but they've also raised about $3 billion of their, they plan on raising about $3 billion from the debt markets. They've sold off some of their airplanes. They've retired some of their older airplanes. So it seems like at this point, by the end of Q2, Delta is going to look like they have about $10 billion in liquidity, which should get them well into 2021, even if they have zero revenue, which obviously is not what we're expecting for 2021. We do expect by 2021, things they're going to start picking up in terms of travel. At this point, estimates for when they'll get back to normal is looking out to 2023. So we're talking about quite a bit of time for these stocks to get back into that $50, $60 range. But I think what we can confidently say is that Delta at this point should have enough liquidity to get through at least the end of this year and the beginning of next year without any additional revenue, which is a great thing. And for me, that's the confidence that I need to start taking a look at some of these types of stocks. And now, I wouldn't go out necessarily buying the stock per se. I wouldn't necessarily go out and buy call options or even leaps on this. The strategy that I would focus on here is really selling put options, because right now, if you look at selling, let's say a May 15th, which is less than, it's about 3 weeks away, I can sell a $20 put, which is still 10% below the current price, and collect $93 per contract, which is 4% of the underlying stock price. Now, you can get a little bit more aggressive and maybe sell a $21 put, which is about 5% below the current price, and collect even more premium if you really want that buffer. So you can really have a lot of choices here, in my opinion, to take a look at selling put options. And this gives you the option to buy the stock, or this gives you the ability to buy the stock at a significantly discounted price. So you're getting about a 4% discount here by selling the $20 put, and this still gives you a $20, a 10% buffer to the downside. Selling a $21 put gets you a 128, which is almost a 6% discount on the underlying stock price. And even if this never, even if you never get put this stock, you're looking at almost 100% yield on your cash that you're putting aside to attempt to buy this stock. So normally, to buy 100 shares of the stock, you would have to put $2,100 aside to place a limit order. Here, to sell a cash secured put, you only have to put $1,972 aside, which reflects that $128 discount, which again is a 5.6% discount on the stock purchase. So that's how I would that would be my preference, to step into some of these names, which gives me a little bit more downside buffer. So, $20 is really the bottom end of the range, which is near where it was trading at during the initial sell-off. Gives me a lot of buffer, collects a lot of premium, and if the stock starts to rise higher, I can take some of this premium and maybe buy some leaps, buy some call options, but trying to collect as much premium as possible now to look at potentially buying this stock as they start to recover, because I don't think that this stock is going to lift off this bottom just yet. Looking at the data, looking at where the stock is trading, looking at the travel data, I just don't see the stock lifting off this $22 bottom anytime soon. So my preference, again, is not to buy calls, not to buy the stock, but to sell puts, because you're really not getting any dividends from this either. So holding the stock is not paying you anything. I'd much rather get a nice chunk of yield for my cash and then use that cash when I'm ready to go ahead and buy into or step into a stock like this. The other name that I want to take a look at is Pfizer. So pharmaceuticals have been doing very well. On Tuesday, I talked about the biotech breakout. That's still in play. Biotech, the NASDAQ biotech ETF broke out above that 122 level, still holding above that 122 level. Looks like it's starting to bounce a little higher. We were talking about selling a put spread here on IBB. This is still, I think, a valid trade as of this morning because it's holding that 122 resistance. Support level, which was resistance prior. Eli Lilly just broke out on earnings yesterday. Looks like Eli Lilly is opening up a little higher, around 161. Pfizer, the reason I wanted to look at Pfizer is because Pfizer's not at a 52-week high. You're not buying something that's severely overbought. I'm looking at Pfizer because Pfizer, as you can see here, is a few different things. First of all, you have this kind of major support or resistance level around this 36, 37 level, which let's draw this at 37 as a nice round number. 37 happens to be what I would consider a significant resistance level, which obviously, as you can see over the last few days, it kind of really struggled to get above 37. It got rejected once here, got rejected once here, and it looks like it's starting to break out. It tried to do that yesterday, but it couldn't break out. And it also happens to be the 200-day moving average. So you have this major resistance here on Pfizer. Now, if it can break out above this, I see a fair amount of upside here versus some of the other pharmaceutical stocks that are already at 52-week highs or severely overbought. I think that those are ones that are a little harder to chase. So I think what you might see is a bit of a decline here, and then this stock might move higher. So the way that I'm looking to play this is by selling a put spread. Selling the 36.5, 33.5 put spread, collecting $1.05, a little bit more than 1/3 of the width here. So we definitely want to take a look at selling premium here because, again, I don't know when it's going to break out. In the meantime, what I want to do is I want to collect some premium, and hopefully if it does break out, then I might utilize that premium to buy some call options or buy some upside if the stock continues to break out. So this is just a sliver of the research that we're currently watching and the different opportunities that are here in the markets, but hopefully this helps you set up your day in terms of understanding where do we sit as the current market goes, again, between oil, between VIX, between consumer sentiment. Things are, I would say, shifting more towards the bullish side rather than the bearish side, which again lines up with our thesis that as the markets continue to look like they're starting to roll over, I think you're going to get a push back into this 284-302 zone. And for those of you that missed us on Tuesday, the reason that area is so important is because that's where the majority of the markets traded in all of 2019. So if you think about after the December 2018 sell-off, starting in basically April, from April all the way through October, the markets were basically sideways in between this 284 and 302 zone. So you have a lot of accumulation of stocks in this area. And for many of you, that you might have found yourself accumulating stocks between April and October of last year before it broke out. And many of those investors are trapped from the perspective of you have positions that you're losing on. And if the markets do push into this area, you're likely going to try to sell your stocks at break even. And that is what likely may end up pushing the markets lower after that. But until that, my thesis is that I think markets are going to push into that 284-302 zone. But again, markets have really stalled at that 284 zone. We really need to see a breakout above that in order for that to happen. So right now, what we're really watching here is on the hourly chart, very, very heavily this 272, 284 level. And just again, when you're thinking about this, when you're thinking about investing right now, My preference again is to sell premium right now. You don't see a lot of movement here, so buying calls and puts, not the right thing to do until you get that breakout while you're kind of in this range bound time zone. Sell premium, collect premium as the markets kind of stay neutral, and in this category, in this range, you're able to pick up some premium. You're going to be able to use some of that premium hopefully to buy some calls or some puts as the market starts to break out. So with that, I just want to again remind everyone, for those of you that ask, how do you get access to the liquidity report? How do you get access to the earnings calendar? We've removed all the links because you can now find it directly on your OptionsPlay platform. So at the bottom of your platform, you now have two links, liquidity and earnings at the very bottom, that you can click on, and that will take you to both the liquidity and earnings report. So this is available to everyone with access to your OptionsPlay account through your liquidity and earnings link at the bottom of your screen. The liquidity report, extremely important to help you understand which symbols you should pay attention to from a liquidity perspective. An earnings calendar giving you an idea as far as what's coming up. And the earnings calendar is organized based on liquidity for you. So if you're trading something that's in the green, those are very liquid options for earnings. The yellow ones are somewhat liquid. Anything below that, you may want to be careful in terms of stepping into. So that's how you can utilize both the liquidity and earnings report for your trading. So thank you so much. Let's see if we have any questions here. Looks like I have a few minutes for questions, and looks like markets are still opening up around 0.5% higher here today. And just a quick reminder, on Tuesday, the next Tuesday, when doing this market outlook, I'm going to have Michael Coe on with me. For those of you that don't know who he is the co-anchor with me on CNBC on Options Action. So he'll be on with me next Tuesday. We'll be discussing the markets together. Hopefully we'll be able to discuss whatever we talk on CNBC tonight a little bit more in depth to help you guys better understand, our views, because again, we keep saying that as much as we love being on CNBC, we really only get 1-2 minutes at most to talk about a single trade and a single thesis. So we don't have a lot of time to discuss those things. So here we have a little bit more time. We are able to discuss in more depth as far as our thoughts and our trades. So we really want to bring that to you here next Tuesday. Let's see. Do you consider going out longer dated on Delta like January 15th? Definitely not from a selling perspective. You always want to sell shorter dated options, Perry. 3 weeks ago, I was assigned Delta at 22. However, the call side is profitable as well. Okay. I don't think 22 is a bad level to own Delta at. There certainly can be much worse levels to own Delta at. How do you manage Intel trades? So Intel is not trading particularly low right now. And one of the things about, consumer spending that we notice here, again, is that if we look at the online electronics spending, consistently strong and only getting boosted higher right now. So we expect that that's going to provide a tailwind for stocks like AMD, Intel. So, I'm inclined to hold on to this for a little bit. If it breaks below 56 significantly, then we certainly will get out. We would certainly like to continue to sell some calls against the $60 call that we own here. The $63 call expired worthless, which is exactly what we wanted. Obviously don't want the stock trading as low as 56, but we want to see if the markets can actually recover a bit back into this 58 zone. We definitely want to start selling $60 call options to collect more premium here on Intel. Let's see. Oil is a very low factor and is not a major component of the S&P. That is absolutely very true. But we're not talking about oil from an S&P perspective. We're talking oil from a economic indicator perspective, really telling us how little demand there is for things getting back to normal. What are those credit card numbers relative? They're relative to the same days of last year. With Intel beating estimates and stock selling off, this is a good opportunity, or a good buying opportunity, or selling put spreads. Again, my preference would be selling put spreads rather than buying, because upside at this point, until the markets again break out above that 284, I think we're very much in a more of a neutral zone. So I'd much prefer selling premium in a neutral kind of position that we're currently in. I have a question regarding BIIB. So I'm not following Biogen's heavily on the individual names. I will say that, You know, this is why I don't prefer playing individual pharmaceutical stocks. I much prefer playing the basket, because in the single stocks, you just have too much single stock risk. You know, one bad clinical trial, one good clinical trial, it's kind of a crapshoot. I certainly don't have any visibility into how these stocks are going to do in terms of clinical trials. So instead of taking on that risk, I'd rather play the whole basket using IBB. What about your Nike trade? Are you going to close it? I absolutely think that we're going to have to close that Nike trade, especially in this range-bound market. You know, we were seeing if this market was going to roll over here, which it looked like it was going to, but you know, at this point, markets remain very neutral here. It still can break below that 272 level, and we still have a couple of weeks left on that particular trade. But you know, at this point, based on everything that we're currently looking at, I'm skewing more to the bullish side here for S&P. Time frame on the left chart. This is a daily chart and this is an hourly chart. All right, so USO, I really would stay away from USO because I don't see the issues of USO being over. You know, I think they are at risk of the same blow up you had with XIV last year with the volatility ETF. You know, they're trading futures, and they were the ones that caused the futures to go negative. That's not a good thing. They are literally causing liquidity issues in the market, and that liquidity issue breaks down the value of USO. So I'm not a big fan of this in my particular opinion. If you're looking to play oil, I think you're better off looking at some of the energy companies. You know, we've seen some the oil name in some of the energy stocks. So with that, thank you so much. I hope you guys, again, find this useful for your trading day. It looks like we're opening up a little higher here today. So best of luck with trading, and I'll see you guys here next Tuesday. Have a great day.